Welcome to the deep dive. Okay, so today we're jumping straight into some pretty dramatic news shaking up the tech sector. Supermicrocomputer, SMCI, you probably know them. They were like the AI hardware darling for a while there. Well, they just saw their stock tank over 16%. It was a real shocker, honestly. And it makes you wonder, right? Is this a blip, maybe a rare chance to buy in? Or is it, a sign of something more serious going on?
Yeah, it's definitely put SMCI under the microscope. So for this deep dive, we're going to look at this recent stumble, but not just in isolation. We need to see it against the whole AI landscape, which is moving incredibly fast. We've got market analysis. We've looked into what makes their tech special. And we're also pulling in insights from the big Stanford HAI Artificial Intelligence Index Report 2025.
Right. So our goal here is really to unpack why SMCI suddenly fell off that cliff, what were the red flags, and then, okay, let's remember why they were called an AI darling anyway. What were their strengths, their competitive advantages? And finally, we'll zoom out. How does SMCI's situation fit into the bigger AI trends, the research, the money pouring in, the economic impact? That Stanford report should help there.
By the end, hopefully, you'll have a much better sense of whether SMCI right now looks more like a bargain or maybe a dangerous trap for investors. Okay, let's get into it.
So the immediate catalyst, the thing that really pushed the stock down over 16%, was pretty straightforward. They missed their earnings targets, missed revenue targets too. And on top of that, they gave really weak guidance for the next quarter.
Ouch. Yeah, that combination rarely goes over well. Did it catch the analysts by surprise?
It seems like it did. Their guidance for first quarter adjusted EPS, earnings per share, was between $0.40 and $0.52. But analysts were expecting something more like $0.60. So yeah, a significant miss compared to expectations. The market definitely voted with its feet on those numbers. So what did the CEO say happened? Were the excuses, well, believable?
Well, the CEO, Charles Liang, he gave a couple of main reasons for the lower revenue, specifically in June. First, he mentioned capital constraints. Basically, not enough cash on hand to scale up production as fast as they needed to. And second, he talked about specification changes from a major new customer. Apparently, some new features were added, and that delayed when they could actually book the revenue.
Okay, so production bottlenecks and customer delays, do he say if those are fixed now?
He did state that these particular issues have been resolved, but, the market reaction tells you people are maybe a bit skeptical. They want to see the proof in the next report, not just hear promises.
Right, show me the money, as they say. And was it just the top line, the revenue, or were costs also becoming an issue?
Costs were definitely part of the story, too. The CFO, David Weigand, he pointed out that operating expenses jumped quite a bit, up 22.6%, actually, to about $315.7 million.
Wow, that's a big jump. Why?
Mostly higher compensation, paying people more, and also just hiring more people, increasing headcount.
Yeah.
So you got missed targets, weak future guidance, and rising costs all hitting at once. It's not a great combination in the short term.
Yeah. It sounds like more than just one bad quarter. It almost feels like there are deeper worries. You hear about this perfect storm of red flags surrounding SMCI, even before this earnings miss. Things like an auditor suddenly quitting, delayed financial filings.
Exactly. And then there were the short seller attacks from Hindenburg, remember those, plus reports of Justice Department investigations.
Yeah, those are serious clouds hanging over a company. How much do those things factor in compared to just, missing the numbers for one quarter? Is it systemic?
It suggests something potentially more systemic, I think. These aren't just financial hiccups. An auditor leaving, especially abruptly, and delays in filing financials that really hits investor confidence hard. It raises questions about transparency and governance. And a Justice Department investigation, well, even if nothing comes of it, it creates uncertainty and risk that just isn't easy to quantify. It points to potential vulnerabilities beyond just the balance sheet.
And, okay, they've had huge revenue growth, right, riding that AI wave. But is the actual profit holding up?
That's a really critical point. The revenue numbers look impressive on the surface, but their gross margins, the profit they make on each sale before overhead, have been falling, plummeting, actually. So they're selling more, but making less profit per item.
And that's happening just as the big guys are waking up to this market.
Precisely. You've got giants like Dell and HPE really ramping up their efforts in AI hardware. That puts enormous pressure on a smaller player like SMCI. Harder to keep prices up, harder to maintain market share. It's intensifying competition.
So with all these red flags piling up, the earnings miss, the costs, the investigations, the competition, what are the experts saying now? Is anyone calling this a buying opportunity?
Mostly the opposite, actually. The dominant advice seems to be caution. You hear the phrase, don't try to catch a falling knife quite a bit.
Right, wait for it to hit the floor.
Exactly. The general view seems to be that SMCI might be fairly priced around where it is now, but with absolutely zero room for error. It's become what analysts call a show-me story. The burden of proof is totally on the company now. They have to show everyone, through solid results, that they can handle these problems and get back on track.
Okay, so a very risky proposition right now. But let's rewind a bit. SMCI wasn't labeled an AI darling by accident. What was it that made them stand out? What was their edge?
Yeah, they definitely had something special. And a lot of it comes down to their focus and particularly their liquid cooling technology. See, Supermicro positioned itself very smartly in the data center and high-performance computing market. They weren't trying to be everything to everyone. They specifically targeted servers and storage for AI, machine learning, big data. That niche focus was key.
And the liquid cooling. That was the real secret sauce.
This was a huge part of their growth story, absolutely.
Mhm.
This wasn't just a component they sold. They offered end-to-end rack-scale liquid cooling solutions. Think about that. The servers, the racks themselves, the networking, and the cooling infrastructure, all designed and tested to work together. It's a complete package.
Okay, so it's integrated. How does the tech actually work? What are the key parts?
Well, the core component is their CDU, the coolant distribution unit. They develop these in-house. They have redundant pumps, so if one fails, the other takes over, and they circulate coolant out to these things called cold plates. These cold plates sit directly on the hottest parts of the server. The CPUs, the GPUs, memory modules, voltage regulators, even PCIe switches, they pull the heat away very efficiently.
And the CDUs are powerful.
Very. They can handle up to 250 kilowatts of heat removal within a single rack, or even up to 1.8 megawatts for an entire row of racks. That kind of cooling capacity allows data centers to pack servers much more densely than with traditional air cooling.
So the benefits for a data center are lower electricity bills, right? Better energy efficiency, that PUE metric you mentioned.
Exactly. Lower costs, lower PUE, which is a big deal for sustainability and operating expenses. Plus, it allows the CPUs and GPUs to run faster and more consistently because they're kept cooler. And you get higher density, fitting more computing power into the same space.
Is there a real-world example of this making a difference?
Yeah, there's a notable one. The GetWorks liquid-cooled data center in Japan. They use Supermicro's solutions for their AI and high-performance computing setup, and it really set a new standard for efficiency over there. It shows the tech works in demanding large-scale deployments.
Interesting. So the tech is impressive, but what about their business model? You hear it described as like heavy engineering, light manufacturing. How does that help them?
That model gives them agility. They focus on the design, the innovation, the engineering side, and keep the actual manufacturing relatively lean. Now, their operating margins might look lower than, say, NVIDIA's maybe 10% for SMCI versus 65% for NVIDIA sometimes, but this approach can lead to a better return on capital. They don't have massive factories tie up money.
And it helps them move faster.
That seems to be a key advantage. Their modular design approach lets them integrate new tech, like the latest NVIDIA GPUs, really quickly. That time-to-market speed is crucial when everyone is scrambling to get their hands on the newest, fastest AI servers. It seems like a sustainable edge in this incredibly fast-moving market.
And it's not just one product, right? There's talk about a culture of innovation, that they're a serial innovator. That sounds like a long-term strength.
It absolutely is. Becoming a serial innovator is hard. It means innovation isn't just a project, it's embedded in how the company operates.
Yeah.
In the rough and tumble world of AI hardware, where things change constantly, that kind of culture is invaluable. It suggests they can adapt, even when they hit bumps like the current ones.
Okay, so that's SMCI's specific story. Let's zoom out now using that Stanford AI Index report. How does SMCI's situation, their focus on high-performance computing and cooling, fit into the bigger AI picture?
Well, the report makes it crystal clear. AI's influence is just growing, intensifying everywhere, society, the economy, even global politics. And crucially for SMCI, the report dives deep into AI hardware trends and even estimates the cost of using AI models, which is falling fast.
Talk about the hardware side first. The report highlights a compute arms race, right?
Definitely. Building these cutting-edge AI models requires staggering amounts of data, computing power, and money. Just massive resources. The complexity keeps going up, the data sets get bigger, and that directly drives the need for more compute. Think about it. The original transformer model, back in 2017, used about 2 billion tokens. Now, models like Llama 3.1 405B takes something like 100 days to train on enormous clusters.
And it's mostly companies, not universities, pushing the limits now.
That's a key finding. Industry has dominated the development of the biggest, most powerful models. That commercial drive fuels the demand for infrastructure providers like SMCI. And the hardware itself keeps getting better. GPUs are the stars, obviously. NVIDIA's latest B100 chip from March 2024 is nearly 34 times more energy efficient than their P100 from just 2016.
Wow, so efficiency is improving dramatically.
It is, and that constant improvement cycle benefits companies like SMCI who build systems using these state-of-the-art components. They leverage those hardware gains.
So the demand for compute is exploding, but you also mentioned the cost of using AI is dropping. That seems almost counterintuitive.
It's fascinating, right? The cost to train these giant models is immense, but the cost to run them once they're trained, what's called the inference cost, is plummeting. The report gives an amazing example. An AI model performing about as well as GPT 3.5 cost $20 lending per $1 million tokens to run back in November 2022. By October 2024, using a model like Gemini 1.5 Flash 8B, that cost dropped to just 0.07 per million tokens.
7 cents, down from $20.
Yep. More than a 280-fold reduction in about a year and a half. It's making AI incredibly affordable to use for all sorts of applications. And cheaper access means wider adoption, which paradoxically drives more demand for the underlying hardware infrastructure that SMCI and others provide.
And it's not just the cost, the models themselves are getting smarter while getting smaller.
That's another key trend the report highlights.
Right.
You don't necessarily need a gigantic model anymore for great performance on many tasks. Microsoft's Phi 3 mini model, for instance, has only 3.8 billion parameters, tiny compared to older models. Yet it performs as well on some key benchmarks like MMLU as the Paul M model from 2022, which had 540 billion parameters.
So 142 times smaller, same capability.
In just 2 years, yeah. It means powerful AI is becoming much more accessible, much more efficient to run. Again, this drives demand for optimized hardware solutions.
Okay, and the economic impact is real. We're seeing actual productivity gains from AI.
Absolutely. The report cites concrete examples. Customer support agents resolving 14% more issues per hour using generative AI. Scientists seeing huge boosts, 44% in materials discovery, nearly 40% in patent filings. AI automation reducing mental load, helping non-native speakers communicate better. All these productivity gains across different industries create a powerful incentive for businesses to invest more in AI infrastructure.
And the investment numbers back that up, right? Billions pouring into AI companies.
Huge sums. CoreWeave raising $1.1 billion, Scale AI $1 billion, Grok $640 million, Perplexity $500 million, and then xAI with that massive $6 billion round in 2024. It shows immense confidence in the future of AI and the need for the tools and hardware to power it. The U.S. is still leading in new AI startups too, meaning a constant pipeline of new customers needing compute.
Of course, with all this growth, there are also concerns. Responsible AI, ethical considerations. Does the report touch on that?
It does. There's a growing global focus on responsible AI, or RAI. Frameworks from the OECD, the EU, trying to put guardrails in place. Issues like LLMs making things up hallucination rates, or ensuring models are robust against harmful uses are getting serious attention. And sadly, we see real-world AI incidents. Facial recognition mistakes, deepfake harassment, even tragic events linked to chatbots. It highlights the critical need for safety and reliability, which might even indirectly push demand for more secure, dependable hardware.
Okay, so let's bring it all back to SMCI. We've laid out the case. On one hand, you've got these immediate, serious red flags.
Yeah.
The missed earnings, rising costs, that fierce competition from Dell and HPE heating up, the shadow of investigations. These are significant short-term risks. Profitability is challenged. That falling knife warning seems pretty appropriate right now. Caution seems wise.
Definitely. The short-term picture is murky, and the company has a lot to prove. But then you weigh that against the broader AI market context. Explosive growth, constant innovation, clear economic benefits driving demand. The need for exactly what SMCI specializes in, powerful, efficient, often liquid-cooled AI infrastructure, isn't going away. If anything, it's accelerating. And SMCI does have those potential long-term advantages, their innovative culture, that speed-to-market edge, their specialized tech.
So it really boils down to this question, doesn't it? For you listening to this, trying to make sense of it all. Can supermicrocomputers successfully navigate these immediate, very real headwinds, the internal issues, the competitive pressure? Can they leverage their strengths to not just survive, but thrive and capture a meaningful piece of this enormous growing AI pie? Or are the current problems too deep, the competition too strong? It really puts the spotlight on that tension. How do you balance the specific risks of one company against the massive, undeniable wave of a technological revolution like AI? It's a tough call, classic show me story playing out right now. What factor weighs most heavily in your assessment?